corner, weighing in at nothing, ready to deduct your life down to nothing. It's Tax, the Annihilator, Deductions. And in the red corner, weighing in at nothing, again, ready to roll the credits on your life. It's Tax, the Destroyer, Credits. Fight! Well, okay, it's not really a fight as such, but not knowing the difference could make you want to throw in the towel. What? That was a good joke. The crowd didn't go wild. Bad joke. Okay, maybe I should just hang up my gloves and I'll just stick to the general tax advice stuff. Hi, it's Adam, your Chief LLC Officer, back again. Today, I wanted to share some insights about tax deductions and tax credits. Tax deductions and tax credits are two different types of tax benefits that can lower a taxpayer's overall tax bill. However, they work in different ways and have different implications for a taxpayer's liability. So we at StartGlobal thought it would be handy to explain the two, so you know which one works for you in the right situation. Let's go. Oh, bless me. So what are tax deductions? Tax deductions are an expense that a taxpayer can subtract from their taxable income to lower their overall taxable income. I'm saying taxable income a lot, but stay with me. For example, if a single person business owner had a taxable income of $100,000 and was eligible for $20,000 in tax deductions, their taxable income would be reduced to $80,000. And this works in the same vein if you are a YouTuber too. If you earned $100,000 last year and your business expenses come to $20,000, you can deduct this $20,000 to make your overall taxable income to $80,000, which means the tax rate is applied to this remaining $80,000, not the whole $100,000. But I hear you ask, how? Well, how do I make a tax deduction? Tax deductions are claimed by itemizing deductions on Schedule A. That's Form 1040. Or by claiming certain deductions on Schedule C. Again, that's Form 1040. By the way, if you didn't know, Form 1040 is the federal tax return for individuals. And it's important to know that not every business expense is a tax deduction. It has to be considered ordinary and necessary for the operation of the business. Here's a quick explanation. Ordinary is one that is common and accepted in your trade of business. And necessary is one that is helpful and appropriate for your business. But I know you, come on, you want to know, what's an example of a business expense that is not ordinary and necessary? Political contributions, fines and penalties, capital expenditures, long-term investments in property, equipment, etc. Although depreciation for capital expenditures can be deductions though, so please keep that in mind. So what are some examples of business deductions? Business travel expenses, advertising and promotion, home office expenses, business-related meals and entertainment, and even business-related vehicle expenses, but I think you get the idea. So, what about tax credits? A tax credit, on the other hand, is a dollar-for-dollar reduction of a taxpayer's tax liability. This means that for every dollar of tax credit a taxpayer is eligible for, their tax bill is reduced by that same amount. An eye for an eye, or something clever like that. So, for example, if a single person business owner had a tax liability of $10,000, meaning they have to pay $10,000 as taxes to the government, and was eligible for a $1,000 tax credit, their tax liability would be reduced to $9,000. But how do you claim for these tax credits? Well, tax credits are claimed directly on your tax return, typically on Form 1040. Remember, that's the federal tax return for individuals. But don't worry, I can hear you. What are some examples of tax credits for single-person businesses? Earned income tax credit. This credit is available for low to moderate income tax payers, including those who are self-employed. Small business healthcare tax credit. This credit is available to small employers, including self-employed individuals who provide health insurance coverage to their employees. Energy efficiency tax credits. These credits are available to businesses and individuals who make energy efficient improvements to their homes or buildings. So, if you think you fall into any of those categories, it's probably worthwhile exploring these options. Okay. Apparently my body functions are making me teleport today. Don't worry, it's not COVID. But to summarize, tax deductions tend to be more common than tax credits. They are also easier to take advantage of because they apply to a wide range of expenses. Tax credits are not always eligible for businesses. It often depends on your income, your type of business, and much more. So do your research before including them in your returns. But for some general advice, as a sole business owner, you definitely want to think more about claiming tax deductions, because those are direct expenses that you can control. And as you work, you can mentally note possible claims. But please keep these 3 things in mind. 1, keep your business records up to date. 2, keep your personal and business expenses separate. And 3, when in doubt, ask a professional. Don't wing it. Oh, darn it. If only you knew a professional company that offered an all-in-one tax package where they took care of legal filings, bookkeeping, taxes, and so on. Oh wait, you do! StartGlobal! I'll leave a link in the description below. And in the blue corner, weighing in at 182 pounds, what? With all the tax advice you could ever wish for, it's Adam, the Chief LLC Officer. Oh no. Bye!